Welcome to Finance, where your money becomes fun. I hold a master's degree in finance and did nothing with it professionally, but I used the concepts I learned to build wealth and economic freedom. I started this channel to help you do the same. Each video is a short explanation of a topic and how you can apply its concepts to your wallet, followed by a case study from my investing experience. I'm not selling you anything, but giving you knowledge. Welcome to episode 4, or the episode on funds, which is, this is a topic in finance that will be a part of many topics, many episodes, because it is a tremendous part of investing. And it's the next step. Once you opened up your retirement account, the conservative or the organically smart thing to do is to start investing in funds. That's why a lot of these retirement brokerage accounts have their own funds. Fidelity has a whole section of funds. Obviously the Vanguards and BlackRocks and State Streets and Charles Schwab. They have their funds. So all right, let's back up. What is a fund? A fund is a collection, most of the time, a collection of, let's say, stocks. It's just going to be a mutual fund, stock fund. So it's a collection of stocks in a particular industry. You can have funds that are just the entire stock market, the NASDAQ by itself, the S&P by itself. But it's a way of investing in something that is managed and taken care of for a little bit of an expense, which we'll talk about in a second. But it's a way to get exposure just to the equities market or the bond market. A lot of 401ks, again, I try to say this at every episode just in case you're getting this episode by itself. The finance thesis is to find fun in this and to build wealth to get to a point of economic freedom, and following the steps that I took. And after opening up a retirement account, after having your bank account, the next step that I recommend is to start experimenting or investing in funds, mutual funds, bond funds. If you don't have a white-collar job or exposure to a 401k, 401ks oftentimes do that. They'll give you a whole selection. Okay, do you want small cap? What kind of funds do you want to go into? A lot of times the 401ks are even a lot more limited than what you can get with, on your own. Which we'll talk about. But so that's why it's the recommended next step, is that you're not taking a big chance. Most or all funds really have a manager who, if something's really going wrong or they're being very vigilant, they're going to make sure that fund performs well over time, so that you can be doing whatever and not paying attention to it. So that is what a fund is. It's essentially portfolio theory, and portfolio theory is, I don't know if it's exactly 30 stocks, but it's saying that, all right, there's a horse race and there's 30 horses. Well, you get to bet on every single one, and there's going to be a winner, and you got exposure to it. It's like a farm. Another way of looking at it, you have a farm, and different parcels of the farm have different makeups of soil or seed or whatever, and you're dependent on that farm to grow and have a crop so that your family can eat, or you can sell it and be successful. And so your farm, you have each one of the parcels, and maybe one's going to have a cash crop, a beautiful crop. Others are going to be duds, but at least you have that exposure to the one. Another way of I like to look at it is for the sports guys out there or girls. You have a football team, or football team's good because you have 11, 11, and 11, right? Special teams, and so 33 essentially. So let's say it's portfolio theory. You have 30 different bets. Well, you're going to have your star players that are going to score a lot, and as long as the team wins, you win. So you're good. that's the fun, and that's why it's good to start there. That's why it's the next logical step in investing or starting the investment, is that you can, one, look at a bunch of things that you can look at the Morningstar ratings, the expected return. You can actually look up a fund and see what is at that moment comprised of. Um, you can see what the expense ratio is, and let's talk about that, because that's a big part of mutual funds or funds in general, is that there's going to be a fund manager, and that person is going to receive a salary, a commission from his work. So when I use the example of the football team. Um, you can almost look at the fund manager, like a general manager of a football team, where he's looking at the players every day. He's looking at their health. He's looking at their age and skill set, if it's improving, if it's not. So let's say this fund manager, and we'll look at an example in a little bit of a sector specific fund, but let's say I'm just making something. Oh, technology. Here we are. We're using technology. They and this is a good example, because I just looked it up for research on this episode, where I looked at some of my technology funds, and I see that Microsoft is now, the big player. I remember when I started investing in them, Apple and some other companies were big, Amazon, and now you see ServiceNow. It all depends. I mean, anyway, the manager, the fund manager is like a general manager, where, like I said, he's looking at every one of these players, the companies, and assessing, almost like fantasy football. I don't play it, fantasy football, but he's saying, I want this person, this company, or this player to carry the team. I'm going to make them to be 15%, 20% of the fund. This company is really doing poorly. They have an injury. If it's a player, let's take them out entirely, or let's trade them for another one. I'm going to sell the fund's shares in, let's say, Logitech. It's not that great of a growth for this tech fund. I don't know why I put that in there, or maybe he took over from another fund manager. Let's put in Seagate, or Workday, or some kind of cloud company. So that is what the manager does, and so you have to pay a little bit for that. But the good thing is that it's supposed to. In an ideal world, the fund is going up, and the manager is just taking a piece of that return that you're receiving. So that's another reason why mutual funds are a great way to start investing and start getting exposure to this, because you're busy, you got your job, you got your family. The manager is there. He's looking at the day to day. He's seeing if there's some kind of scandal. He's listening to the reports. He's seeing if a competitor out there is getting great reviews with a different product. Their job is that fund, and their job is to make it grow. They will make it grow, and then they get a little piece of it. So usually the further it grows, the bigger it grows, the bigger their piece is. So they're incentivized to make it be beneficial for you, for all the fund holders and themselves. Let's go into two things really quickly, and then we'll actually look at a fund and a little bit of a hack that we'll maybe employ later on. The one thing that we just have to make sure that you understand is that for most of these funds in the retirement accounts, they have a minimum $2,500 initial investment, that kind of thing. You can sell after you make that investment, and I have some that have $300, $600 in there. But that initial investment, they want a minimum of whatever, 2.5K kind of thing. The other thing with funds is, again, you can have bond funds. There's all different types of funds. I like to look at it, let's see, maybe like 3 or 4 different types. One, you have a fund that is essentially just an index. It's there's not much. The fund manager shouldn't be gaining a lot of expense ratio, because it's really just the S&P or the Nasdaq. It's it's comprised of what that index is comprised of. A long time ago, not a long time ago, about 10 years ago, there was a lot of heat in the financial advising industry, because a lot of people were saying, "Hey, I can just throw my investment in an index fund and it's outperforming you stock pickers. Why would I do that?" And they had a case, they had a strong case. Again, this is like 10 years ago, 2015, 2016 around. Why take that risk if you just, that's a very conservative bet. And if it was beating stock pickers, for shame. Anyway, then you have industry specific funds. So the biotech, technology, like we just talked about, healthcare. You can do everything. Real estate. Uh, let's see what else. Agricultural, chemical. I mean, really anything. Uh, the other type of fund is size of the companies. A lot of times you'll hear small cap, mid cap, large cap. Those are, when they say cap, that's a capitalization. That's how big the company is. So a lot of times it's, again, yeah, I want to, don't give me hate, but a lot of times the large cap is more conservative. There's less of a, because they're so big, and small cap can be a little bit risky. You can go, it's not as sure, but if it does go up, it will go up higher than mid cap. So we have those three. We have index, size, sector, and then I guess we would call the ETFs. That goes with bonds too, with the size of the bonds, what they're in. Is it government? Is it corporate? What kind of ratings? Again, that risk reward, where the riskier corporations that may not pay them back should get a better return than the ones that are AAA rated and the like. And then the thing just to talk about briefly, and we'll go into each one of these later on with videos, is ETFs. And ETFs are funds that trade like stocks. So you can go in at 11 o'clock during the day, buy that fund, and that's part of your portfolio. Mutual funds act a little strange, where you buy, let's say it's Monday today at 11 o'clock. If I bought into a fund, I don't actually get in there until it closes at the end of the day. So a little bit of a hack that I used to employ was, if I see there's a tremendous dip happening, well, all right, I'm going to get in at the close. So usually, we're going up and down, up and down. Maybe that's a nice way of at least just getting in there, and the next day you have a feel good rise. I pulled up a funds page on Fidelity.com. This is a fund actually that we're looking at it, and it's overall rating 2 stars. This has been a tumultuous fund. This is a Fidelity Select Biotech portfolio fund. You can see the risk is a little higher. The expenses are kind of low. Returns are low. Biotech right now, I mean, we're in 2024. It's a very strange industry. 2 cents on it is that, of course, there's the weight loss drugs that are tremendous, but biotech's been in a little bit of a rut recently, just because there's a lot of things, and let's not go into this. Let's keep it fun and simple. But what I just wanted to show is one is the overall rating. You see here the Morningstar rating. When you go in, usually with your retirement, and we should do this for a video later on, buying one. You can say, and this comes with a lot of things with a fixed income too. You can say, I only want 5-star rated. I only want ones that have a very low expenses. I only want ones that have an expected high rate. Of course, this stuff it's not certain, but it's good research to do to pick what you want. Again, I touched upon it on a prior episode. A lot of times with this stuff, especially when this is the first time you're looking at it, you kind of want someone to just tell you what to do. And that's what I'm trying to help you fight, is that this is actually fun. This is cool. And this is actually a craft and a skill that you're going to start using and developing. And you're going to get better with time. You make mistakes in the beginning, like anything. And hopefully, there's some things that I'm teaching here that you can mitigate those mistakes. So anyway, you see the ratio, the expense ratio. Let's see, expense ratio gross. Okay, the minimum to invest. Wow, is none. That's great. Turnover is essentially the stock turnovers, like how many times they're changing. Because, like we talked about with the fund manager, they're going in like with like a fan football team and picking which players to play. And then this is a little bit of the hack that we can employ later on when we start doing individual stocks. If that's something that you want to do, and something that I do recommend, go ahead, hate. But you can see the top 10 holdings at the time. Let's see, as of, okay, they have the date. And you can see here the AbbVie, Amgen, Regeneron, Gilead, Biogen. You can see what is the top 10 holdings. So these are the top 10 companies that this fund manager, oh, so yeah, let's look over here. Fund manager, he's been there since 2005, a very long time. And he's knee deep in it. But again, like I said, so why do you invest in a biotech mutual fund? Well, uh, there's a bunch of reasons, but let's say it interests you and you think that there's going to be an exciting return for whatever reason. Maybe it's the um, I was going to say the weight loss drugs, but I don't think the weight loss drugs are really here in this one. Like the Novo Nordisk and the Eli Lilly. But let's say that it's something that interests you. Uh, you want exposure to biotech. But you don't know that much about it, but you want to be an individual shareholder, and you want to pay for this expense ratio. You can go in and see what these guys are kind of recommending, and they're recommending it with their money, everyone's money and the fund. So if it's just a little bit of a hack of saying, hey, I don't want to pay someone to watch over this. I want to have some fun with this. I want to see what they're recommending. And you could say, like, okay, here's AbbVie. That is his top holding at this time, 13%. You can start doing your own research on AbbVie and say, like, oh yeah, why is it? And maybe I didn't know that this. Again, this is biotech. This drug was in the pipeline. This drug is awaiting approval. I want to invest in this. I want to own some shares, so you can buy it outright. So that's mutual funds. But yeah, we'll purchase some in a later video just so you could see the whole thing. But it's a great way to start getting your feet wet. One last story in regards to funds that I'll tell. It's with the extra benefit of owning stock that we'll go into in another time. Maybe actually a whole video, definitely, maybe a series of video just on that. Besides making money on capital gains and dividends, and we're losing money, what extra benefits you get from owning shares. And in this case, because we're talking about funds, a fund. The story is that it was, I don't know what year, 2019, I would say. And I was working next to the Intercontinental Hotel in Miami, which is a very large hotel, and they have a lot of conferences. And their ground floor is a lot of big rooms, conference rooms, where they have meetings. And I worked next door, and when I would want to take a break, get up, check the stocks, I would walk around, and I would walk around the hotel, and I saw a beautiful, beautiful, giant breakfast. Cart is a bad word for it. I mean, it was like a train going into this meeting room, conference room, and there was a desk, admissions desk right outside, and a few people working, and there was a logo, Novo Nordisk, and it's a very unusual logo with the bowl and the moon. And I, for whatever reason, just went up to the desk, and they basically, I remember they did the initiative of just asking my name, and I went, oh, no, I'm just walking around or whatever. And I said, oh, what is this? And they said it's a Novo Nordisk shareholder meeting. Are you a shareholder? And I said, oh, I don't know. That's okay. And it just kind of walked away. And I was not a shareholder outright. I knew that, but I went, oh, let me just look the funds that I have, the mutual funds in Fidelity. And I went through them, and then, lo and behold, just like we went and looked at the funds allocations, I see that Novo Nordisk is in one of the funds. So I go back and I see the lady, and I said, oh, I made up a little bit of a white lie. I said, I just got off the phone with my financial advisor, and he told me I'm a shareholder. So I would like to go in and see the prospectus, whatever. And she kind of was like, wait, what? And so I took out my phone and I showed her. I said, yeah, I was a little confused before because it's part of one of my mutual funds. And it's a big piece of it. I have a lot of money invested in this. And so she talked to someone else, and we looked at the fund, and then we looked at I logged in and showed my ownership, and she said, "Okay, all right, here you go." And I walked in and had a delightful breakfast. It was a free breakfast. I did watch their presentation a little bit, but then I said to myself, "Man, I got to get back to work for a phone call or a meeting. I forget what it was." But yeah, I mean, once owning the fund is the same thing as owning the shares. You just have a custodian or whatever you want to call it. But I was a stakeholder. I was a shareholder. So that's an extra benefit of finding fun in finance. I don't recommend going around and looking for these shareholder meetings, but I do get invitations in the mail when ones are in Miami Beach. I know Berkshire Hathaway has their event every year. But it's a great way of having fun with finance, of having fun owning these companies and these shares, and being a part of the company as a true stakeholder. So have fun, maybe get breakfast. I'm sure there'll be more stories just like that. So stay tuned. So this "you did what" section is a mistake that I made. First, let's back up and kind of talk about where my mistake happened, and it happened from hearing advice from at this point it was the talking heads on CNBC. Jim Cramer always says this saying: "Bulls make money, bears make money, pigs get slaughtered." So what does this mean? Again, if you just learning about this stuff, a bull is someone who's long or optimistic that the economy or stock is going to go up. A bear is someone who's pessimistic, that thinks it's going to go down. And what he's saying is that pigs are people who are greedy, and they get slaughtered because their greed takes over and they lose sight of what they're trying to do with this investment opportunity. Really quick aside, it all comes from I think they used to have bears and bull fights in the 1800s or something like that, and a bear strikes down and a bull goes up when they strike. So that's where the origin comes from. But yeah, this is one of those things where Jim Cramer and others say it, and it sounds smart, but I think the case study of this is here I am trying to teach and trying to help, but the lesson is not to listen to all these people, and to make up your own mind, and that's the thing that I hope you do. So I made a mistake. Let's talk about the mistake, and I'll never do something similar again. And maybe that is a mistake. I don't know, but I learned from it, and that is selling Microsoft. So I I bought Microsoft in 2018 for like $80. Um, this was 2018. I mean, the new CEO took over, I think, 2014, and they were getting big into the cloud, and kept on going up and up. It was a great investment. My wife and I had a friend who worked for Microsoft. His name was Kiki, and I remember always getting Enrique, or we called him Kiki. And I remember getting the dividend and being like, saying, "Kiki, what did I say? Kiki, pay me. Kiki, pay me." And my wife would be like, "What are you saying? Who peed? Where? What?" And I would say, "No, Kiki paid me." Um, so it was a great investment, but for whatever reason, Jim Cramer's saying, "Bulls make money, bears make money, and pigs get slaughtered," echoed in my head. And I said, "Wow, I received such a tremendous capital gain right away. Am I a pig? Am I getting greedy?" Um, so I did the unthinkable, and I sold it. I think it was at the 130 level. Right now, it's over 400. And yeah, let's look at the chart right now. I mean, I lost out on a tremendous upswing. This was 2019. Of course, it went down with COVID, but no one saw that coming. You know what? Maybe that saying takes part in a somewhat speculative stock that you go, "Wow, look at this! I didn't expect it to go up so high," and maybe I'm going to get greedy and think it's going to go higher. But something like Microsoft, that's a real giant component of the economy. I was a little silly or just not right. I was wrong in selling all of it away. I made a nice little profit. I thought I was smart, but the smart thing would have been to hold on to it. And Microsoft is another of those companies like Apple or Nvidia at the time now, where you just hold it. It's just part of your estate. You could pass that down. You could donate shares. You can give that away when and keep it in your family like forever. So it's a tough lesson to articulate. I feel like an economist, where you say on one hand that's a smart thing to do, sell it off once you made a nice piece, and the other hand is saying, don't. But I don't know. I think if I had to just give you what my lesson is, or words of advice is, don't listen to people. Don't let sayings get stuck in your head, and just do what you think is right. Have fun. Have fun with this. This is, if I did the same thing with a Carvana or a different type stock, maybe I would have dodged the bullet and had a nice return, and the saying, was right. But it didn't work out for me on that one. Ignore sayings on stocks. Sayings go for other things, not your investments, not things that you believe in, and don't feel obligated to act one way, especially if someone on TV is saying something, or on YouTube like me. Here we go. Being wrong is part of being alive and being human, and just learning from those mistakes and not repeating them is one of the best things you could do, from that experience. So that was mine, selling Microsoft at $130. Here's the chart, and I keep on buying into it now, which is probably a little bit of a mistake because of this nostalgia and being like, "Oh, I want to get back into that." But don't feel pressured by anything, especially someone on YouTube or to CNBC tell you to. All right, that's the episode. Please subscribe, like, and comment any questions or topics you'd like me to cover in a future episode. Log on to finance.com to learn more, and let's have fun with finance.